What's going on, everybody? You are listening to Investify. My name is Craig Curlop, aka the Fi Guy, and we've got an amazing show for you today. Brian Green, the dude with the Verizon stores. I've never heard of anybody's story start out this way, but he all started owning Verizon stores. I didn't even know you could own Verizon stores. And this dude's out there scaling his Verizon stores to like 23 some odd stores. The man has a pretty good sale and goes into real estate. And what he did with real estate is even more exciting because it's just one of those things that kind of can show you how you stack. You start off kind of small, started off in the small multifamily realm and started to grow into the kind of mid-sized multifamily realm. Now he's in the larger multifamily realm, and he kind of explains a step-by-step process. One of the most powerful things that he talks about in this episode is how to actually raise money from friends and family, as well as how to structure those deals so it makes sense for your friends and family as well as yourself, and how to talk to sellers on off-market deals to help you get seller financing, to help you get good terms for these deals. And one thing I loved too is what he mentions about how to write multiple offers on the same property and let the seller pick which offer is best for them. And so there's tons of little good nuggets in the show. Brian is honestly one of our most eloquent guests yet, I think. Like, his story was very easy to follow despite having achieved a tremendous amount. And so make sure you listen front to back. And yeah, it's a really, really good episode. So thanks so much for listening. Before we get into the episode, I just ask that you leave us a rating and review on iTunes. It is super, super helpful to have us get the best guests, keeps the show going. So appreciate you guys big time. With that being said, let's bring on Mr. Brian Green. Brian Green, welcome to the show, my friend. How you doing today, dude?
Craig, I'm doing great. Thanks for having me.
Yeah, man. Super pumped to have you on. I know we chatted. Shoot, it's probably going on like 2 years ago about, I just remember our conversations in San Francisco about hiking, a shared love we have. And, it's cool that you're doing it in the Northeast and I've done it out in the Rockies. And yeah, man, I think I've only hiked one mountain in the Northeast, and that's actually where I'm from. So
yeah. I mean, it's a challenge either way. I think just don't look too far down on us here in the Northeast. I know our mountains are not quite as tall as yours, but they're still mountains nonetheless, and it's still enjoyable either way.
Oh yeah, I mean, hey, it's funny because they're probably still about the same distance from the base. We just maybe have a little less oxygen that we're carrying with us up in Colorado. Exciting update, guys. The Fi team is now powered by Place. In addition to having so much more to offer our clients, we're now able to grow our team in all 50 states. If you're an investor-friendly agent seeking a top 1% real estate team to join, reach out. I'd love to talk about how we can partner to accelerate your career. Reach out at thefiteam.com/apply. Yeah, man, I'm excited to have you on, and I want to hear about your story. And like all good stories, we like to hear about them from the beginning. And so tell us kind of like, what got you started down the entrepreneur path, and, what made you change from, maybe living that typical American dream life to entrepreneur.
Sure. So I started getting into my own business right out of college. In college, I worked for a gentleman that was a retired executive from Verizon Wireless. So I actually worked in his paging store for a while in college. This is in the late 90s. And then soon after I graduated, my brother, as well as myself, both went off on our own with his help and kind of started our own chain of wireless stores. So I opened up a chain of Verizon stores, and my brother opened a chain of Sprint stores.
By paging, you mean like you sold pagers?
We did, yes. So we sold pagers, the things that you wear on your hip and they beeped. So I'm probably slightly older than you, but that was what we sold in stores before there were phones.
Yeah, I guess that was 90s, wasn't it? I was like, yeah. I guess it has to be, because I do have memories of my dad having a beeper or a pager. But like, man, they were very vague. So, man, that's crazy. Yeah. So, yeah, how do you go like from college? What was your degree in?
Finance and marketing.
Okay, so finance and marketing. You had an internship with this guy who was like a mentor of yours from Verizon. Mm-hmm. Do you think the college helped you, like the academia part of college helped you in your role here?
Um, I mean, loosely, just the familiarity with like terms and I guess my experience using Excel, I guess, was basically what the finance courses in college amounted to, like how to evaluate a stock, which the actual practical use of that is not helping me today, but the comfortability level with using that type of analysis, I guess, helps. So loosely speaking, yes, it helped a good amount, but the lessons I learned working for him and then afterwards on my own in actual running a business were far superseded what I learned in college.
Yeah. And so what were you doing for him? Like, what was your low level intern level job?
I was doing sales in a retail store. So we were literally selling pagers and eventually cell phones to customers when they walked in. I did that for several years, and then eventually it turned into me running my own store. So he was kind of my angel investor as well as my mentor. Opened up my first store that went fairly well, and then we kind of started scaling it. And eventually I built it up to a chain of 23 stores across the Northeast, some in Vermont, Massachusetts, and mostly in upstate New York.
Wow. So I think this is like how maybe clueless I am with in this field is that I never thought Verizon stores were franchised. I just thought Verizon owned all the Verizon stores. And so I'm wrong. What does it take to open a Verizon store?
So I'm sure it's different today than it was, 20 odd years ago. But the way it was back then is there was stores that Verizon themselves owned, corporate stores, and then probably half of the other locations were privately owned. None of them franchises; they called them independent contractors.
Mm,
So we had a corporate contract, literally, with Verizon to sell their products, and they'd pay us fees like commissions for selling the phones. And then they would give us some seed money to open up more and more stores, but that's basically how it worked. And then we would earn a residual as well on every customer's bill in for an extended period of time, sometimes like 3 to 5 years after they signed up. So it was fairly lucrative at first, and then as the market matured, it kind of became less and less so.
why is that?
Only because the margins on the product started to come down. So at first, you can think of the time when like the iPhone came out and all the first Androids. Everyone was going out to get like their first smartphone, and their bills were going from like those old plans that might have been like $40 a month to the plans that we all pay now that are more like $100 to $200 a month. So there was this big growth phase in wireless, and we benefited greatly from that. And then after a while, the market matured. There was stores everywhere. People bought their phones online, and so margins started to depress over time.
I see. So the
Yep.
internet really took a toll. So you made more money on the actual sale of the device than you did on like the plan itself.
We actually lost money on the device, if that makes sense, and we made our profit on the commission that Verizon would pay us. So we took a subsidy on the device, and then we made back a commission. But we'd make anywhere from $200, $300, $400 every time we sold the phone.
Gotcha.
Yeah.
Gotcha. Okay. And so, I mean, clearly that you like something about this business because you opened 23 stores. So you don't open 23 stores without liking it. And so
Yeah.
what did you like about it?
I like the control aspect. I didn't necessarily set off to become an entrepreneur or open my own company or run my own business. But once you get into it and you understand that you have direct impact over all the processes and systems that you can set up, you control who's being hired and what they're getting paid. You can kind of control the entire ecosystem. So that control of like your own financial destiny and like where the company's going was very alluring to me. That's kind of what I liked. And then as I was able to optimize the way we did things over time, I was just able to improve kind of the profitability of each of the stores, and that's why we expanded. But I was definitely heavily involved in the business. It was more of a lifestyle business than any type of investment.
Gotcha. So you didn't go and evaluate, okay, what does it look like to open a Verizon store versus maybe back in the day it was like a singular store
Mm-hmm.
versus Sprint versus T-Mobile, whatever. Like, did you evaluate all those or?
No, I mean, my business mentor, I'm sure did, but me being 22 years old at the time, I was just grateful that I had the opportunity to open a store and that somebody else was going to fund my store and help me get my contract with Verizon. They're not generally handing out contracts to 22-year-old kids with zero experience. So the entire reason I got that contract was because he had relationships with corporate Verizon. So I was grateful for that opportunity, and then once we started going, it kind of just snowballed.
Cool. Did any of the employees, I think a lot of people are going to deal with this
Mm-hmm.
listening, even if it's within real estate, but I suspect you hired a lot of people that were older than you. How did that go?
I did at the management level. Most of the sales reps were around the same age. You can imagine 50 so odd sales reps, all around 20 to 25 years old in cell phone stores. Older managers, though, I think at first maybe there was some hesitancy on their part because I was younger. But once I think we formed that relationship and had a couple conversations, they realized that I knew what I was talking about, and they kind of I think they then had confidence in the fact that I could get it done. Um, but there was definitely an age gap there at first. I actually wrote my final management paper when I got my MBA about this exact thing, about the dynamic between younger owners and managers having to hire older employees or bring on staff that was in a greater age than themselves.
Yeah, I think it's really interesting, and I think a lot of people
Yeah.
are dealing with that. And so, did you have to give your mentor anything as part of that story? Did you share any profits with him or anything like that?
So he was very lax on detail, more of like a big picture visionary type guy. So yes, so for I don't know the next 10, 12 years that we ran that business and built it out, we gave basically we split profits. It was very subjective and loosely based, kind of like, hey, we had $50,000 this quarter, you get X and I get X, and we'll just figure it out. But then when I
Mm-hmm.
got at the end of the journey in 2014 and I had an opportunity to sell the company, he deferred and said he didn't want any of the profits. So that was good, obviously, because we had a successful exit. Um, so I don't know. It was very subjective. I think that he did do it for financial reasons, but he also did it just because he wanted to kind of use his resources and help a younger business person kind of advance in the marketplace. So I think it was twofold for him.
Cool. No, I love that. I love finding the mentor that's just doing it because he wants to kind of give back. I guess two questions: where is that mentor today? And two is, what'd you sell the business for?
So I'll start with the easy one. The easy one is we sold the business for $4 million plus
Nice.
inventory. So it was a great exit, and that's what launched me into my career in real estate, which we can get to. Mentor, I actually, strangely enough, have no relationship with anymore. I once read a book about this, and he was talking about the mentor mentee relationship, and he kind of the author. I can't remember the source. I'll think about it once we get off the call here. But he was talking about how mentees kind of outgrow mentors at some point and like that dynamics changes and there's kind of like a natural progression where they kind of go their own ways. And I never really looked at it that way. I was kind of aggravated for a while that we didn't have a relationship as we move forward, but then once I read that, it made perfect sense that it was just like there was a time in our lives where it made sense to have that relationship and it was mutually beneficial, and at some point we just kind of outgrew each other. um,
Mm-hmm.
and now today we really have no relationship, which is maybe sounds some strange to some of your listeners, but I feel like that would be more common than most people think.
Yeah, I mean, I think back to some of the mentors that I've had over the years, and I still like them, and I have nothing against them. But yeah, like there's no reason for me to talk to them anymore because while like 6, 7 years ago we were right here, I went just a little this way, they went just a little that way, to now the point where like it just there's not enough overlap for it to make sense. So
Mm-hmm.
I would agree. I could absolutely see that. And I'm actually
Yeah,
glad that you said that because I was kind of like, man, I haven't talked to this guy in a while, and like I don't need anything from him, but like I kind of just want to talk to him because he did a lot for me back in the day. And
yeah, yeah,
you know,
yeah.
so
I think it's very similar to just having friendships in life, right? Like you have your high school friends, your college friends, and like at some point, like there's a season for everything, and sometimes it makes sense to stay connected, and sometimes it doesn't, and it's not really a negative; it just kind of happens.
yeah, absolutely, absolutely. And if he ever came knocking at your door, I'm sure you guys would have a very nice dinner together or something like that, right? Like I don't know. I always think like, yeah, you can stop pouring into relationships, but still welcome them if they end up coming back for some reason. Cool, Brian. So you sold this business for $4 million. Is this? I mean that is like retirement for a lot of people. Is that something that you would you recommend someone who's young now to get into that business to try to grow it over the course of 10 to 12 years, have a $4 million exit? Like, do you think that's repeatable?
Today, I would say no, only because I feel like where we are today, specifically in that industry, but also just in retail, it would be very difficult to kind of scale. I think a retail business to that level today. it's not impossible. It's the chances are against you to do that. You'd be much better served trying to do it in e-commerce or some other type of online based business if you're going to be in retail products. There's millionaires everywhere on Amazon Marketplace. That would be the easiest. The path of least resistance would be there, I think.
For sure. So kind of like modern day e-commerce is what you were doing.
Yeah, I think so. I mean, back then, it was just the right time. It was the right business in the right time in a growth industry, which I don't know if in a physical store could be replicated today.
Mm-hmm. Mm-hmm. Makes perfect sense. And so you sell this thing for $4 million. Now, is that to you like a large sum of money? Like, is that like, holy crap, I've never seen this much in my life. I could retire now?
It was, yeah. I mean, at the time and even today, it was life changing. It completely changed the trajectory of my business career. Up to that point, the business was very lucrative, but it was, like I said, a lifestyle business. So like, I was earning a high amount. I was pulling off a lot of profit, a high amount of profit to pay for all of our living expenses. But there was never like this time where there was like $1 million in the bank. Like that never happened because like I was constantly putting money back into inventory, and it put off what it put off, but there was no exit. I wasn't even thinking of it. So $4 million was a huge number. And at the time I wasn't sure what to even do with it because I was never a guy that had that much cash in the bank. So like, I went through the series of talking to all kinds of different investing professionals to see what their opinions were. And to be honest, none of them really stuck with me. They kind of spoke to me like I was, some 65-year-old that was just going to park money and live on this 4% rule that seemed nonsensical to me. Like, how am I going to do that? It doesn't make any sense. So go ahead. Because I knew I had enough money if I wanted to, but I did not have enough money to support a lifestyle that I wanted to have. So I knew that I needed income, and I needed to kind of build up a income stream that would provide for the lifestyle I wanted, and not just have a chunk of change.
It's funny. I was joking with my buddy, this guy Mike DeHaan. Do you know Mike DeHaan? He's a co-bro.
I do know him. Yes. Yeah.
Yeah. Okay. So me and Mike were joking around, and he was like, the worst thing you could ever do is just randomly get $5 million. And so it's almost exactly what happened to you. And we're like, wait, what? And he's like, well, it's like enough to be really excited, but when you really dig down and think about it, it's not enough to not work anymore for a lot of people that want to live like an upper middle class lifestyle.
Yep.
And I just thought that was like really funny. So I think this is exactly what happened to you. Is like, okay, like I'm comfortable,
yep.
But yeah. So you got this $4 million. Now, are you paying taxes on this? Like, how does that? I mean, is it truly $4 million that you're getting here?
No, that's the first problem. So the first problem is I turned around and wrote a check to the IRS for $1 million, it was painful. Yep, this is before the time where I knew anything about deferring taxes or cost segregations or any of that. I just blindly wrote $1 million check. So now there you can see I'm down to $3 million. I think after everything was washed out, I might have ended up with like 2.8 because after I had to pay the New York State some tax as well. So now when you look at a 2.8, it's still a lot of money, but to your point, it's not enough to just shut it down and do nothing.
Mm-hmm. And so what did you do? So, you talked to a bunch of, it sounds like traditional financial advisors who probably have never seen that amount of money and probably don't have $5,000 to themselves in their own bank accounts. And so what do you do?
So like they're pitching me on index funds and whole life policies and all the stuff that's in their workbook of things to do. So I did decide I think I placed most of the money with a guy from Goldman Sachs just in random index funds as a placeholder basically until I figured out what I wanted to do. And I wasn't satisfied with their answers at all. So I started, just kind of doing some online research and started reading, find Rich Dad, Poor Dad and a bunch of other real estate books and kind of go down that rabbit hole. And about 3, maybe 4 months after selling my business, I bought my first small multifamily building. Because my thought process at that point was, okay, I think at that point I was like, I want like 150,000 in free cash flow per year. That on top of the nest egg I already have, I should be good to go. Like that was my thought at the time. So I was like, all right, I probably have to I have to get X amount of units to get up to that cash flow. So all this started making sense to me from a business perspective. I was going to be able to run my own thing and still be an entrepreneur, not have to go work for somebody else. So that's why I kind of transitioned into real estate.
Gotcha. And so what year was this?
2015, I bought my first property in the spring.
Okay, so 2015. So this is what we call our for
The for
real
real deal.
This is the first deal that you ever do as a real estate investor. And so tell us, you mentioned it was a small multifamily. Where'd you buy it? How much did you buy it for? How'd you finance it? Like give us all the details.
Yep. So this was a while ago. So today, before our call, I did do some research to refresh my memory here. So I ended up buying the building. I think it was for $215K. It was a 4-unit multifamily brick building. It was in a small town near where I live. The previous owner had fixed up most of it. It was like an abandoned building before that, but it was definitely not like a finished product. So I bought it with all cash because I didn't know what I was doing. So I had cash and I spent it. So I paid $215. Immediately we had to put a new roof on. So I was actually, $215 was after a seller credit for the roof. So he basically paid for the roof. I had put in a new parking lot driveway, which was maybe another $5K. And then we did a bunch of miscellaneous updates and repairs, call it maybe another 3, 4, 5,000. And then I found new tenants and I leased it out and I increased rents slowly over time. But I think it was within 90 days, I went back to the bank and refinanced it because I probably read another book that then I realized I should have financed it from the start and not used all my own cash. So I did a cash out refi and pulled off, I think, $155K out of the money I put into it. And then I literally held it, managed it as a rental for the next, I think, 7 years before I ended up selling it.
Do you remember what it appraised for? Like that 3 months later?
Well, I don't even know if they did an appraisal because it was so soon since I bought it that they were forced to use the purchase price that I bought it for. So they would only do it at the 215. So I think they gave me it was something like 70 to 75% of the 215, but they were locked into that contract price. Yeah.
Cool. Okay. Yeah. It's funny. That's like kind of called delayed financing. I don't know if you ever heard of that. But it's a pretty common strategy and it's decent when you can like score a good deal on the front end because you're paying with cash. And so I don't know if your realtor like told you that or whatever, but like, if he was listed at 215, you probably could have paid 200 for it cash. But I don't, that's neither here nor there. And so, again, like at the time it seems like a big deal, but like now it doesn't matter whether you're paid 200 or 215 for it. Cause what did you sell it for 7 years later?
Yeah. I sold it for 355. So, and part of the reason I sold it was because it's in a market that doesn't have a ton of appreciation. So, I think that I think I made 140K on the investment over 7 years, plus, all the cash flow we made while owning it. So it was still a good investment. But it was never going to turn into like $1 million building. So I ended up selling it to take the profit.
Yeah. And that's interesting, right? Because you can kind of see that in those smaller markets, you are like, there's always that kind of balance of cash flow and appreciation. And I suspect that had pretty good cash flow because the appreciation, yeah, it wasn't amazing. Like what were you cash flowing on that property?
Yeah. So again, I had to go back to my notes. So at the time, I think I ended up with like 65K into it and I was cash flowing like 10 grand a year. So I think it's 15 to 20% cash flow, which is pretty good. But again, the appreciation was kind of capped out. Even if I still held it today, I sold it 2 years ago. If I had it today, it'd still probably be worth 355. Like it probably wouldn't have gone up anymore.
Right. Right. And so you kind of got to know your market and you got to know, hey, if I'm in a smaller market that's not going to get the appreciation, you have to make sure the cash flow is there. And if you're not in a cash flow market, like, even like us in Denver, right, where we do a lot of our business, like we can get creative and still manufacture some pretty good cash flow. But the glory in real estate is the appreciation. And so after that first deal in 2015, did you catch the bug or what?
I did. So I then bought 5 more buildings in the next, I call it, year and a half. And on I think the second and third one, I quickly figured out the BRRRR method. So then I started buying them with still using all my own cash. So maybe this is to your point before. I bought them all with my own cash, used all my own cash to renovate them, and then I went back and refinanced them and effectively pulled out all of my own cash in most cases. In some cases, even a little bit more. So I was burrowing back these small multifamilies to myself and then just keep stacking the buildings on top of each other. So that was the strategy I went with immediately thereafter when I realized if I keep buying these buildings and leaving my money in there, I'm going to run out of money. I'm not going to get to my unit count that I need to get to. So the burn method is where I went.
And how did you learn about that? Because this sounds like it was before Brandon and David Green kind of like made that method really popular.
This was around the same time. So I think 2015, 16, I think they might have started in 14 or 13. When I found Bigger Pockets, though, along with reading a number of different books on real estate, I think they were in like around episode 100, maybe 200, something like that. But I've listened, I think I listened to their first 500 episodes, through 500. So I've got all that. So back then it was very heavy on BRRRR, and like it was like a whole new thing. And this is before the book came out, but they were talking about it in concept. I don't know if he actually labeled it yet, but this is what he was talking about even back then.
Gotcha. Yeah. No, that's awesome, man. And in that time, right, kind of like the late teens,
Mm-hmm.
the burr was it because like, contractors weren't insanely expensive yet. Prices were increasing. So you had like a market tailwind that helped you kind of boost those levels even over a 6 month period that you would be kind of doing the rehab.
Mm-hmm.
Um, today it's much harder to do. And
Mm-hmm.
so you scaled from your quad to how many burrs did you end up doing until the end of your burr season? How many did you have?
Well, we still did it for a while. So I got up to 24 units, I think, across 6 properties by 2018, just doing it myself. And then at that point, my brother came on board and partnered with me. And then we continued to do burr, but with slightly bigger buildings, somewhere in the 20 unit count, um, all the way. So from 2018 through today, since he's been partners, we've gone from, I don't know, 5 million in real estate up to 25 million. But we're still kind of doing the same business model. We're just burrowing bigger buildings, and yes, it's way more difficult to do with financing where it is today. But we're still making it happen where we can.
And so what got you into, so it sounds like you were still like pretty dead set on quads though. Like you were doing the maximum amount that a conventional loan would get you because I'm no genius, but I could do that 6 times 4 is 24. So
Yeah,
was that kind of your,
it wasn't exactly that math. It was a 6 unit and a couple threes, but yes, I was doing mostly residential financing. The 6 unit I actually bought with private money using private notes with family and friends. But yeah, I think that the comfort level to scale up came when my brother came on board, and also came with his resources. Right, so now we're doubling the capital we have available to purchase these. Um, so, as soon as he came on, we bought a 9 unit, then we bought a 20, then we bought another 20 and a 16. So we were able to kind of just push further. Plus, I knew that when he came on, now I got to double my cash flow goal, right? Because now I'm just not working for myself. I have to, get his number up there too. So effectively, we had to 2x all the goals that I had set originally.
yeah, I love that, man. So you mentioned something that you liked the residential financing, but you went ahead and you raised money from friends and family for your first, larger than 4 unit deal. Can you tell us a little bit about how you went about doing that and how you had the confidence to ask and what came first, the money or the deal?
The deal did in that circumstance. So that deal I got from sending out mailers, which I still send out mailers to this day to try to source deals. But back then, it was off a mailer that I obtained the deal. I got it under contract, and then I raised the entire purchase price and the renovation, so 100% of everything. And we did it all. I did it on private notes, so I paid them 10% return, I think, at that time. And it was actually my brother before he was my partner, and my father that put all the money up, and I executed and did all the work. Um, how I had the confidence, I think this was my fourth or fifth one, and so I already had 3 or 4 in the books, and I knew exactly what it was going to be. Um, I became pretty good at underwriting, and I knew what the value was going to be and how much the construction cost was going to be, and I just went ahead and did it.
I love that.
Yeah,
And so like that 10%, so you gave him a 10%, were there any points or anything like that? Or was it just 10%?
just 10%.
So that's some pretty nice financing. Definitely
It's
some family bank financing for sure.
yeah, yeah, no
Um,
doubt. Yep.
and and was there a term on it? Like was it 12 months or?
So I think that one I did a 24-month term because it was a pretty heavy value add type deal. We renovated the entire building top to bottom and all 6 units. I was giving them, I think at the time, I think I even negotiated even on that first one accrued interest. So like the interest was all accrued till the end. I could be mistaken on that. I might have had to pay them quarterly distributions. I think let's say it was quarterly distributions, but interest only. So I was able to kind
Mhm.
of to navigate that through the course of the deal because we still had some tenants in place and I was getting cash flow on maybe half the building. But effectively, I used their cash, paid them their returns, so they were happy. And in the end, I got a brand new building that was perfect because everything was renovated, ready to go. Um, and the deal worked out fantastic, and I still own that building today.
Wow. And so do you remember like what you bought it for, what you refinanced it for?
Yeah, it was roughly 265 I bought it for, and I want to say that I spent all in. I think we spent 415. So what the difference would have been in construction and closing costs, and then when it was finished, it appraised for 715. So
Wow.
yeah, it was
That's a home
awesome.
run, dude.
Yeah,
Yeah.
yeah. So those are hard to find now, but at the time, that was a fantastic deal.
And did you know going into it, it was going to appraise for 715? Like, was that what you underwrote?
I think I underwrote maybe like 650, but we were able to. In most cases, I'm pretty conservative on the rents that we're going to get, and we were able to get exceed the rents that I thought we were going to get, and so the value pushed up a little bit further. So yeah, it was fantastic.
And that's the advantage of doing the 6 unit, right, versus a 4 unit, is because it's directly correlated to how the property performs versus how the one down the street sold.
Right, and that's why today I exclusively do commercial buildings. I don't do any residential ones, or if I do, I buy a residential building with commercial financing because they'll appraise it still on operating income, and I can kind of still control that process.
Super interesting, man.
Yeah.
And so, how would somebody do that? How do you buy a residential property on commercial financing?
Any bank will do it. I mean, you just go to a commercial lender versus a residential lender, and they're only going to finance it one way. They're going to order an appraisal. They're going to do it off of the appraiser's going to give you like the cost approach, the income approach, which is the one they're going to use, and then the comp approach. The difference would be that the commercial lender is going to use the income approach for valuation, and the residential one's going to use the comparable approach. Um, so depending on the building and the income that it produces, sometimes that can benefit you and sometimes that can make it worse because those numbers are rarely ever going to be the same. But they'll do the deal just like any other. But you can put it in an LLC, doesn't have to be in your name. The terms are going to be commercial terms, so you're going to get more like a 25-year AM or a 20-year AM instead of a 30. Your down payment is going to be larger. But in a lot of cases, they'll be able to give you a higher LTV. So most of our commercial lenders would go up to 80%, especially on a stabilized property. Whereas on a residential one, you might not get up that high. So there's some differences.
Yeah, no, absolutely, man. And so, would you say doing something like this would be advantageous for a beginner to do, or do you think someone that's in their first or second deal should just kind of stick to the residential game for a couple?
I would say to not be scared off by it just because it seems more complicated. I would weigh both options. The challenge with new investors is generally they have less capital to deploy. So you're probably going to be able to buy a residential property with lower financing. Although you can go in and get a commercial loan and they'll give you a construction loan. So they'll basically fund a portion of your construction as well, which most residential lenders may not do on an investment property. So I think you need to kind of I don't discount it. I would check both options if I was a new investor, and I would go to a residential lender and see what they can provide, and go to a commercial lender and see what they can provide. Many times, the same bank will have two different people you can talk to, and they'll tell you right there what that one bank will be able to do for you.
100%, 100%. A lot of it is your strategy. Now, like if you're looking to house hack, I mean, it's hard to beat 3% down, 5% down, move into it, turnkey, right? Like I think but you can only do one house hack a year. So house hacking, it's not really scalable. It's just like you can just kind of slowly stack them. But I think like if you can house hack, there's no reason why you shouldn't. I mean, I know like David Green. I think we all can know that he probably doesn't need to house hack anymore,
Right.
but
Yeah.
but he is still because it just makes so much sense.
Yes.
Um, so awesome, man. And so like you go from the single family stuff. Now, did you sell all the single family stuff or just that one you mentioned?
The small multifamilies, I've sold a handful at this point. So I think we've sold 4 properties that we bought in the early days.
Okay. And did you 1031 those into larger stuff?
We 1031 one of the buildings. I think the other three, I had an intention to do a 1031, but could not find a new property. So I ended up just taking the profit on those. Um, I still avoided the taxes though, because, we're kind of heavy value add developing type real estate investors. So we always have a lot of losses on our properties that are rolling forward. We cost segregate everything. So I was able to wipe out the profits with just general losses. And didn't have any implications from a tax perspective.
Okay, I want to dig into that a little bit because I think a lot of people talk about, you know, they get stressed in a 1031 exchange if they can't find a property to buy. It almost feels like you're going to go to jail if you don't find the property. And
Yeah.
so,
Yeah.
how do you kind of stay level headed through that and know, like, hey, I'm not going to buy a deal that's not a deal. I don't care if I lose money.
Yeah. For me, I mean, when I buy a piece of property, not only does it have to fit our return requirements, but I also have to want to buy the property. Like when you buy a property, you're basically marrying it. You should buy it as if you're never going to be able to sell it. Like this is your investment. What if you just got stuck with it and you had to have this thing for 10 years? If you don't have that conviction, you shouldn't buy it. So for me, like paying a little bit of tax, even if I didn't have the losses, is not the worst thing in the world. I always joke with people on our team that these are first world problems, that you have enough money where you have to pay a little bit more tax. There's nothing wrong with sometimes taking profit off the table, paying a little tax, and replenishing your own personal balance sheet. So I wouldn't get overly stressed about it. If you have an opportunity to do a 1031 and it makes sense, then go ahead and do it. But I definitely would not force it just to save, a couple, even 10, 20, $30,000 in taxes.
Yeah, you're tripping over dollars to pick up pennies at this point, right? Like, you're don't get yourself into a bad deal because you're trying to save on taxes.
Right. Absolutely. And I'm always the guy that's always like, how much time and brain, space is this property going to take from my life? And like, just to do that, just to save a little bit on taxes just seems crazy to me, but people do it all the time. I just don't understand the methodology. Like if it's a good deal, it's a good deal, then go ahead and do it.
Yeah, no, I love that.
Yeah.
And you started buying multifamily property. It sounds like 2019, 2020. Is that right?
Mm-hmm. Yep.
And so this is cool because the timing is nice because like it felt like everyone was buying multifamily at this time. And so I
Mm-hmm.
think maybe you were a little ahead. Like you kind of were probably one of the early, you were kind of doing it almost, but like kind of before it was cool. Right. And then I feel like in 2021 in particular, I
Yeah.
felt like everyone and their mother was going into multifamily. And so how did you kind of handle that with like maybe the increased competition, having to go way over asking, all of that kind of stuff? Like, how do you keep your wits about you when the market's going crazy?
Yeah. So, again, as you know, at this point in time, my brother and I are still self-funding everything, and we're only raising capital on private notes. So we're not really in the frenzy of like buying like 50, 100, 150 unit type buildings, where all of those deals are syndications or private capital or investment level capital. So we're really competing against mom and pop landlords and then small operators that are local to our market. We're in that space where we're buying stuff that's like 5 to call it 40 units. So it's a little bit less competitive. It's a little bit too big for the smaller players, a little bit too small for the bigger players. So that helps a lot. We're also trying to always source deals that are off market, so they're not as competitive. Many of our deals, like I mentioned before, we get from mailers, which some people seem to find crazy that we're still getting stuff off mailers, but we just bought one again last year off a mailer. I'm a broker, so I see anything that comes across the MLS. We're just kind of casting a wide net to try to find any and all opportunities that we have in front of us to make sure that we can find a good deal. But generically speaking, if I was just a regular investor and only looking at stuff that was publicly marketed, it would be very difficult to find anything that makes any sense.
Gotcha. And so when you're sending these mailers out, is it difficult to find like where the owner is because they probably don't live in the property that you're targeting? So like, how do you pull those lists and, is there some sort of metrics that you look for?
Yeah, so we pull data from a bunch of online sources. Currently, we have the most success using PropStream. So we can go in there and kind of put the buying criteria and the geographic proximity that we're looking for, and then it'll basically pull out all the ownership information. You can also skip trace, get their phone numbers on that website, but it's not really great for that. So we get that from external sources. But once we have all that data, we upload it into our own CRM, and then we just do a mailing campaign where we send out a generic mailer. We change it a little bit every couple months, and we're just hoping something sticks. Like if we send out mailers to all the properties in our market that we might be interested in, We're in the Albany, New York MSA. I'm specifically in Saratoga Springs, just north of that. So there's literally like 800 properties that we're interested in buying. So we only have to send out 800 mailers. We just need like one of them to pick it up at the right time where they're interested in selling. And that could change the dynamics for the whole year.
Right. So how often are you sending these mailers out?
We try to do it every couple months. So what's that, six times a year, something like that. We change the format a little bit. We'll do professional letters. Once in a while, we'll do postcards, but the letters seems to work better in this size property. And we might get a 1 or 2% response rate, but like I said, we just need one person in a given calendar year to make all the mailers worth it.
Yeah. And how important is it to stay consistent? Like and also how likely is it that you get somebody who wants to sell on the first round of mailers?
That is rare, although not unheard of. Generally the way I've seen it work is somebody will get our letter, they'll call us to see what we're all about, to vet us a little bit, and then that turns into like a series of phone calls over the course of 3, 6, 12 months before they're actually ready to sell, and then that turns into, okay, now I'm ready to sell. I've talked to you for the last year. They actually feel like they have some connection with you because they've talked to you the whole time, and they basically give you the first right at it. In many cases, that's what it comes down to. So they're not gonna give it away to you, but like they feel some obligation, some relationship with you from having those conversations that you've put the work in to do, and now you have basically the first right of refusal on the property.
Nice. And a lot of these guys, um, are they like open to seller financing? Do you try to go for seller financing? Like what's your pitch?
So I'll usually do it a couple different ways. Usually you can tell when you're having a conversation with the owner, like if they're actually going to be interested in that or not. Every seller has their own benchmarks that they're trying to clear. Most of them want their number, whatever that number is, right? Just so they can basically say that they got the number. So some people are very interested in preserving their capital and not paying taxes. Other people don't really care as much. So usually what I'll do is I'll bring up the topic in conversation, and if they seem at all interested in it, then I'll make them, when it comes time to make them an offer, I'll give them like 2 or 3 different options. One will be a cash offer, which includes for us bank financing. One will include seller financing, and there might be some other one that includes a combination of those two. But and then I'll let them choose and see what they want to do with it.
Gotcha. Yeah, I've heard that strategy from a couple of different people of like submitting multiple offers and let them pick, especially more in the commercial space than in the residential space.
Yep.
When you're talking to these owners, are you mentioning like, do you say specifically, "Hey, would you be interested in seller financing it?" Or like, what's your pitch on there?
I just try to. I mean, these guys are just like us, right? So they're landlords, they're real estate guys. They like talking about their property, so I just try to get them to talk about their property as much as possible. Like I just try to not say as little as possible. At least I try to, and just let them keep talking. And then as they describe things like trying to do a 1031 or not wanting to pay tax, I will just say, hey, well, have you ever considered seller financing to avoid the taxes for a number of years until we can pay off the note? And then you just kind of work it into conversation. I don't ever start the conversation with like, hey, we're interested in buying and we want you to sell or finance it. Like you got to work it into the conversation where it makes sense. Now, if I'm talking to some like professional operator that I know is not going to hold paper, like they just want a price, then I'm not even going to bring it up. I'm just going to talk about the price and see if we can work on that.
Totally. Yeah,
Yeah.
I think it's important not to bring like your real estate investor deal making lingo to somebody's property, right? Like especially if you're talking on the residential side, like if you're buying your first residential property, like you should never mention the word seller financing. You should never mention the word deal. It should be like your home. It should be like property, or like you understand the problem. Like you need to understand from the seller's perspective when seller financing makes sense. When they give you that problem, that seller financing can solve that problem, then you bring it up. And even still, you don't say seller financing. You just say, hey, would you be down to carry a loan on the property and not take the full sum? And so you
Yep.
just describe seller financing without actually saying it.
Yep. This is a mistake I've made a number of times, and I still struggle with this now. So when I'm having conversations with owners, I have a tendency to be very direct, and depending on on who you're talking to, that can put them off, and then they basically just kind of shut down. Like if they think that you know more than they know, or you start using, to your words, the lingo that like a deal lingo or seller financing, and they don't know what you're talking about, they immediately are not going to sell you the property because now they feel like they're not they think you're going to take advantage of them because you know more about it than they do. So that's the fastest way to kill a deal is to speak over the top of the person you're talking to on the phone.
Absolutely. I mean, it's all part of negotiation, right?
Yeah,
Like when you're negotiating, you want to sound dumber than the other person. Have you ever heard of bimbification?
I have not. No, what is that?
My wife was into this for like a little while, but it's mainly around women who take advantage of this. And so, and I'm not saying this in any way, but obviously we know that generally people tend to. This is a horrible thing, but people tend to think that women maybe don't know stuff about construction or about real estate investing, right? Because it's a male dominated field.
Sure.
And so a woman who knows a lot can pretend to know nothing and like
Yeah.
kind of have this
Yeah.
guy feel bad for her, get a really good deal, and like all that kind of stuff.
Yep.
Like it works a surprising amount. Um, and yeah, so it's almost like that, right? Like you want to sound dumber than the other person, so that way they feel comfortable operating with you. But really, you can kind of be, you know, get what you want. It's all part of the deal. It's all
Yeah.
a game.
I think my problem is I'm a very poor actor, so I kind of get myself twisted up in some of those conversations, and it's not great. Eventually, I definitely need a full time acquisitions person to take those calls over from me.
Yeah, you just have to be dumber, Brian.
Yeah, yeah.
Uh, awesome, man. Cool. So, how many units do you now have today?
Uh,
And like, where's your portfolio at?
Yeah, so I think we're roughly at 25 million for portfolio size. Almost all of that is owned by my brother and I. We have in our market that amounts to 128 doors. I think we have 14 or 15 properties right now, different properties. Um, Four of which are still under construction. They're being redeveloped right now, like major renovations in all four of those. And then we just started a ground up construction project, which will be our biggest to date. That one is a combination of 6 condominiums that are being put into a old historic apartment building, and 36 ground up apartments that are being built to the rear of that on the same property. Um, that's also the first project where we raised like real syndicator level capital. So we have LP partners on that deal.
Okay. Wow. So I was gonna say, it sounds like you kind of went from doing it all yourself on like the small multifamily side, bringing in your brother for like the medium multifamily. Now you're kind of getting into the big boy stuff. Why that jump?
The jump was I mean, I like to be challenged, so I think that for me, I would get very bored just doing the same 4 unit, 6 unit, whatever over time. I mean, I like the idea of like the hunt, finding the new property, but like once you get into it, it's kind of the same thing over and over again. So I didn't necessarily need this big of a jump to go to make myself challenged, but this one came from stemmed out of I think it was 2022, 2021, that same time you were talking about, where it was highly competitive and there were just like no deals that were available on the marketplace. So we were going through a number of different opportunities that were on the market and off market, and we couldn't find anything that penciled out. So eventually, we found this deal that was an old house on basically a lot, and it was zoned properly for redevelopment. So we kind of went forward with that, and we kind of hired some consultants to help us with construction financing build out because we'd never done that before from the ground up level. And then we just kind of kept evolving and kind of figuring out one thing after another until we ultimately got it under contract, and then we started going through all the type of municipal approvals and permitting, which took much longer than we thought it was going to. It took about 20 months. And then
Jeez.
fast forward all the way up to today, where we're breaking ground and the project is underway.
So Brian, are you planning to like refinance this, pay everybody back, and keep these 36 units yourself and rent them out, or are you planning to sell it all off and take your money and run?
So the business plan on this one is to sell off the condominiums that are in the old historic buildings, and then we'll take the profits from that and repay investors. And then when the apartments are finalized, probably 6 months after the condominiums be finished, we're going to refinance that, to your point, pay back all the investors, their initial capital is the business plan, and then they're going to stay in the deal. So they're not exiting; they're actually going to stay in and own 50% of it, and then our team will own the other 50%, and then our property management company will manage this for cash flow and try to hold it. The thought is to hold it as long as we possibly can. We projected out a 10-year hold plus. Eventually, at some point in time, it'll make sense for us to sell it, but for now, it's a long-term hold.
Okay, cool. And so when you say like, how does that work structurally? Like, so these investors invested, how much do the LPs have as part of it now versus how much do you have as a GP?
So it's a standard syndication. So the way we structured it is it's a 50-50 ownership split. Although the LPs put up most of the capital. We raised 2.55 million, and then we rolled in our developer fee as the developer of the project, which is just shy of 600,000 on this project as our equity. So all in, we're at like 3.15, but our ownership distribution is 50-50, which sounds lopsided, although there's a ton of work on our side to get this thing off the ground and completed. And the way that ours is structured is us as GPs, excuse me, are not going to take our developer fee or any profits until the LPs get all their capital back.
Gotcha. And so they get paid their initial capital,
Mm-hmm.
and then they're still 50% owners. So like, where's your incentive, I guess, to pay them back the
I
initial
don't get paid
capital?
anything. I don't get paid anything
Oh,
until they get their initial capital back. So
oh,
not
okay,
even our
gotcha.
developer fee. Yep. So we get them all their capital back. Then we take our developer fee, and then all the profits are 50-50 after that. So my incentive is
I
to do
see.
it as fast as possible.
To get that
Yeah.
600K. Gotcha.
Yeah.
Makes perfect sense. Okay, cool. Yeah, no, so what's interesting about this commercial space too and syndications is that there is like a million, probably more than a million different iterations in different ways to structure these deals. It's just what works good for you and what works good for the investor, and literally nothing's on the table. Nothing's off the table. On the residential side, which a lot of us are more privy to, like you kind of have to be a square peg fitting in a square hole.
Yeah, I agree too. I mean, you can be, I mean, I've seen people that have done portfolios of single family homes and maybe done it a little bit more strategically. But yeah, I mean, on its face, when you're first getting into real estate, if you're doing single family homes or on a smaller scale, like it's pretty cookie cutter the way you're going to put that up. But I mean, the structure we're going with is the oldest one there is, right? You put up all the money, we do all the work, we split it 50-50. That's kind of like the original joint venture or syndication model.
Absolutely, absolutely. No, that makes perfect sense, man. And so, and you mentioned that this project is taking a long time, like 2 years plus. How are you able to kind of like keep your investors at bay with this? How are you and how are you feeling about the project now? With, I mean, 2 years later, like underwriting is different.
Yeah. So we went into it, I think, with fairly conservative underwriting. So we're okay there. We were planning for a slightly lower interest rate, as you can imagine. So we've had to adjust a bit there, but we built in enough into our construction budget and kind of our overhead that we were able to absorb it for the most part. Investors came on not originally, so we got it under contract in like the spring of 2022, and then we didn't start raising money and form the syndication until February of 23. So at this point, investors have had their capital in for, depending on when they contributed, somewhere between, call it 4 months and 12, 13 months. But the expectation going in was that there would be no distributions basically for the first 2 to 3 years. So everyone was kind of on the same page with that timeline. And even now, our construction phase, shouldn't take more than 14 to 16 months now that we're started. So we've had all that time built in. So expectations are still on track.
Okay, awesome.
Yep.
Yeah, no, that all sounds good and dandy, man. So it sounds like it'll be hopefully a pretty good investment for you, and
Mm-hmm.
hopefully, and for your investors. And I think that's kind of how you continue to obviously stack them up. And so, like, what's next after that? Are you looking to continue to do more big syndications?
Yeah, I mean, we're open. Depending on how big the deal is, we've looked at some smaller joint venture models too. So, I think it depends on the amount of capital that's needed. I think that if it's anything basically under $1 million, we'd probably just do a joint venture with 2 or 3 mining partners. If it's over that, we probably have to switch back to the syndication model and go from there. But we're somewhat flexible, and we're still open to buying small stuff and self funding that too when it's opportunistic and it makes sense. So I just like the fact that now we have all these tools kind of in the toolbox and we know how to do each of them. And depending on what the deal looks like, maybe one makes more sense than the other. We can kind of go that way.
Totally. You know what's cool, man, is that you took that $4 million from Verizon, and you're still kind of recycling it, and it's just, it almost looks totally different now. You probably can't even find that same 4 million, but like,
No, yeah, no.
and how much it's, but that was
Yeah.
what started it all, right? I mean, at the end of the day,
Hmm.
so it's pretty cool to
Yeah.
see. Um, awesome, man. Well, we're heading into the final part of the show now, which we call our final four. Any parting words of wisdom for the listeners before we head there?
Parting words of wisdom. I would say there's nothing more important than educating yourself before you go buy something, but not to the point where you never buy anything. So there's a very fine line there that everyone has to walk where you can't just jump in without knowing what you're doing, but you also can't sit around and analyze spreadsheets for years on end without doing something. So the biggest part about being an entrepreneur is knowing when you're comfortable enough to jump, because you're never going to know everything. So that would be my. I'm sure they've heard that before, but I just want to reiterate that because that's like the biggest thing that changes somebody from wanting to be an entrepreneur and somebody that's successful in being an entrepreneur.
I couldn't agree more with you, man. I see it all the time. In particular, if you're an engineer, I feel like I see this the most with
Mm-hmm.
engineers because they tend to overanalyze and they try to get into every single detail, and every single box needs to be checked in order for them to move forward. And they end up buying one house or two houses over the course of a 4 or 6 year period. But then you've got
Mm-hmm.
like the sales guys who aren't very details, right? You, me, and that are just
Yep.
like, yeah, screw it, let's just buy it. And then we're like, whoa, we have all this wealth now, right? Because it's like we didn't get all like worried about the details and are the utilities going to cost 200 a month or 250 a month? Like it doesn't matter. Like just buy the dang thing. And so, um, yeah, no, I love that piece of advice. Okay, let's head into what we call our
The
final
final four.
four. All right, Brian, what book are you reading right now?
I'm reading Anti-Fragile by an author, Nassim Taleb. I don't know if anybody's heard of that. It's a very dense book, but it's about kind of like his own personal philosophy on like anti-fragility is what he says. He's basically using that as a term for people that have a stake in the game, they have skin in their decisions, they do things that are difficult because they know they're going to benefit from them long term, versus the population of people that are fragile, is what he calls them, and they're able to. He calls them like academics or government officials or corporate executives that can make decisions that only have upside and have no downside. So it's a very interesting book. It's I'm probably not explaining it very well, but if you're somebody that's interested in just reading through kind of the thought process that goes into like why some people are one way and other people are a different way, it's a fantastic read.
It almost sounds like digging into like the rich dad versus poor dad stuff, where like the poor dad likes it safe, likes the pension, like you know, so there's no downside, but there's also very limited upside.
Yes,
Or
yes.
am I
And he
not?
takes it maybe one step further than that, and it talks about the having too much, only having upside, no downside. So, like if you're like a politician, for example, you can make rash decisions because if they benefit, you could end up being governor or president. But if the worst case scenario is you basically lose your job and then you go get a corporate job making probably three times as much, you have almost no downside. So, like he's talking about that versus like the entrepreneur, which is basically risking his whole personal fortune on his decision making and taking a huge risk, which has upside, like astronomical upside, but astronomical downside at the same time. So that's kind of the premise.
Gotcha. It's a book I'm gonna have to pick up. Cool, man. What is the best piece of advice you've ever received?
This is going to sound funny. It has nothing to do with real estate, but when I was 16, 15, I started getting into weightlifting. My uncle Bob, who was the guy that got me into it, his words of advice were never lift in front of the mirror. And his rationale was this. Stay with me for a minute. His rationale was: would you rather get into a fight with the guy lifting in front of the mirror or the guy lifting in a dark closet? And the obvious answer is you'd rather fight the guy lifting in front of the mirror because he's innately weaker and he's more worried about the vanity of it than the actual performance. So the way I kind of extrapolate that comment, I'm not sure he meant it that way, was what you do when no one's watching is kind of what's most important. So like things like, waking up early and reading and putting in the work and, doing the exercise when nobody else is watching or you're not watching yourself in the mirror. That's what pays dividends long term versus, being the guy that's sitting there doing curls in front of the mirror and is enjoying, just the moment. So
Yeah,
there you go.
the guy with his cell phone in the locker room, like trying to make his like angle his muscle in a certain way in the light.
Yeah,
Man,
yeah,
there's so many times I
yeah,
just want to be like, dude, you are such a tool. Like when people are doing stuff like
yeah,
that, I appreciate that comment, that knuckle comment.
yeah, yeah.
Come on, well, what's your why? Why are you doing what you're doing?
So I got two reasons for this. So one is I'm having fun. So that's one reason. I enjoy the challenge. I like to be mentally engaged in what I'm doing. So that's a big part of it. The second part of it is I feel like I've put in so much time into this, and my brother as well, and our whole team, that we're kind of getting to the level of expertise in our field. And I feel like we have an obligation at this point to kind of use that to not only enrich ourselves, but like our friends and family as investors, and everyone that's kind of in our circle, for lack of a better term. So I feel like our why is to provide financial freedom and elevate the people that are on our team, the people that we're investing with, and all of their family members. So I think we have. I think in the end, it's money driven, and I know the why is not supposed to be money driven, but it's not really about the money. It's about what that money will do for all those people.
Totally. I love that. I love when the why is just like, cause I want to, cause I'm having fun. And that's great.
Yeah.
Cool, man. What's one thing your dogs could say that would completely ruin your image if they could talk?
Hold on. What's that again? So, what's the one thing my dogs could say that would completely ruin my image? Man, I don't know. I've got two dogs. What could they say ruin my image? I don't know. They'd probably say something about like, something like you're not as strong or you're not as smart as you think you are. Like, I don't know. So, it's coming from a dog. That would kind of crush me. I don't know though. That's an interesting question. Like, I don't know where you got that from, but it's going to make me think all night now.
Yeah. Do you have mirrors where you lift weights? That's my question.
I do not. There's no mirrors in my garage or at the gym I go to.
Really?
No,
so you take that advice, you still hold it.
It's absolutely. Yeah.
I love it.
Yeah.
No mirrors in the bathroom either, right?
No, there isn't there. I'm married and I have 3 daughters, so there's mirrors everywhere for that.
Yeah, fair enough.
Yeah.
Awesome, man. Cool. Well, where can people find out more about you if they want to learn more about your story or if they want to reach out?
Yep. So we have our website for our property management company is SaratogaStays.com. Our investment wing is GreenspringsCapitalGroup.com. And we're on Instagram as well. So at Greensprings Capital or at Saratoga Stays is the best place to find us.
Cool. Awesome, man. Brian, thanks so much for your time, dude. It's been an absolute pleasure having you on and getting to know your story a little bit deeper. And yeah, man, we'll be in touch. We'll talk soon.
Excellent. Thank you, Craig.
And that was Brian Green. Man, what an episode. I just absolutely love Brian. He's such a cool dude. And I just love how he was able to, he's a business guy at heart, right? Building up those Verizon stores for the first probably about half of his career at this point, then transitioning into real estate investing, starting small, getting bigger. And I'm no genius, but if I can see a trend that he's going to continue to get bigger and bigger because he loves it. He loves the hunt. He loves finding the deals. He loves making the improvements and loves seeing things happen. And so definitely go check out, Brian, go check out his property management company. He's doing all this in New York, right? Where property taxes are high, where it's almost impossible to find deals, yada, yada, yada. But he's still doing it. He's still making stuff happen. And so he's just a wealth of knowledge. I absolutely love him. And I love his advice there at the end where he said, never lift weights in front of the mirror, or don't work out in front of the mirror, because the vanity doesn't matter. How jacked you are doesn't matter. The pump you have doesn't matter. Just go out there, do the work, put in the reps, build yourself up mentally too. I think mentally you get stronger when you're not looking at yourself in the mirror. And, then you're going to see tremendous results from that. So loved his advice. And guys, thank you so much for listening all the way to the end. We appreciate you big time. Again, if you haven't already, please leave us a rating and review. It helps us tremendously grow the show. And with that being said, we'll see you next week. Hey, you made it all the way to the end. Thanks so much for listening in, guys. My mission with each episode is to inspire all of you to take action on your real estate investing goal. Whether you're looking to grow your current portfolio or ready to take the jump into your first deal, each guest we've had on the show was at one point in the same exact place you are. Some right in the same exact spot right now. No matter where you are in your journey, reach out at thefiteam.com or DM me on Instagram at thefiguy. I'd love to help you take the next step.